Hi, so this video will be looking at accounting for limited liability companies, cooperatives, nonprofit organizations, which is the broad topic in a sense. However, the focus of this video will be on accounting for corporations, of course. So the broad topic is, split. So we'll be focusing on the corporation aspect of it, which is for companies, limited liability companies specifically. So we talk about a limited, we'll be going through this textbook to understand the theoretical aspect of it, and of course, assess the practical aspect and how we treat a question if we're working with companies. Companies can be quite unique in the sense that it is usually one of those tough topics, to be honest, but after a while to grasping it, yeah, it makes totally much more sense. Yeah, so let's get into it. We talk about a limited liability company. We're referring to an organization that we say is incorporated, right? So it is incorporated for some purpose. And usually the aim is to make a profit, of course, because we're in the business of making profit. The owners of these companies that we refer to, we call them shareholders, because we sell shares as a means of raising capital. And anyone who owns shares in these companies, they're considered to be shareholders. So the definition here that you see is an organization. So a limited liability company is an organization owned by its shareholders whose liability is limited to their share capital. Saying that their liability is limited to their share capital is specifically talking about the limited liability aspect of it. We say that companies typically have what we call, one of the features of a company is separate legal personality. It's a separate legal entity. It has a separate legal personality. In the eyes of the law, a company is like a separate person, an artificial person. So it can do basically just about everything that a person can do, but except under the law, of course, except that you cannot do natural human stuff, obviously. But under the law, the law sees a company, a limited liability company, as a separate legal entity, separate legal personality. That's one of the features. When we talk about limited liability, it simply means that a company can sue and a company can be sued in its own right. You don't have to sue the directors of the company to sue the company. You don't have to sue the shareholders to sue the company. If you're a shareholder in a company, if you're an owner of a company, you are not affected. You are only liable to lose whatever you have invested in the company. That's it. You will not lose your personal asset. So that is what limited liability speaks to. It simply means that your liability, whatever you're liable to lose, is restricted, is limited to whatever you have invested in that entity. That is what limited liability means. So if things go south and the company is being sued, for example, and it needs to find money to pay out this lawsuit or whatever, and it doesn't have enough money, it cannot go into your money as a shareholder because you're protected by limited liability. You're only liable to lose whatever you have invested. You cannot lose your personal assets. And of course, unlimited liability, would speak to you are actually liable to lose your personal assets should things go south, like with a partnership. Because a partnership typically mostly have unlimited liability. So if you're in a partnership and the business is going south, sometimes you have to tap into your personal assets and things, your personal money, your personal assets to, keep the business afloat or to pay the business obligation. Just like a sole trader, it's your business. The owner and the business is one and the same, even though we have separate legal entity in the fact that you must keep your accounting records and treatments separate from your personal records, business from personal, yes. But at the end of the day, if somebody's suing you, your business as a sole trader, they're basically suing you. If the business money cannot finance it, you have to dip into your personal money, dip into your pockets to finance it. That is where you have unlimited liability. Your liability is not limited. You are liable to lose just about your personal assets or anything should something go south. With a company, it's safer. You're only liable to lose whatever you have invested, and that is what we mean by limited liability. Yes? All right. So this is just going through a comparison, sole trader partnership and limited liability company in different aspects, of course. So we talk about sources of finance liability company, we talk about shares. So I just mentioned shares. A company raised capital by issuing shares. Yeah, that's what I mean. We sell these things called shares. Shares is like a stake in a company. Think of a pie or a pizza. You have a pizza, 8 slices, right? If you buy 2 of those slices, then your ownership in the company is 2/8. Whatever percentage that is. I think that is what? Quarter? 25%? Yeah? You own 25% of that pizza. Or you'd have gotten 25% of that pizza. That's a share. So you're literally, think of it like you're literally getting a share, guys. Like you get a share, right? Yeah. So the company, the capital of a limited liability company, a limited company is divided into small units of equal amounts called shares. The value of a share in a limited company could be as low as 1 cent, but $1 shares are more typical, and shares with other face values are possible. When we talk about face value, it is the same thing as us saying par value. Let me write it here. Par value is the same thing as face value. We talk about, and the same thing as nominal value, yes? So face value is the same thing as par value and the same thing as your nominal value. And it's usually the amount that the share is authorized, quote unquote, to be sold at. But you can sell them above par rather, or below par value, above the face value or below the face value. It's just that companies are, I said companies are incorporated before, right? Now in this incorporation, there is something that governs a company. We call it the articles of incorporation. It is like a constitution that governs the company. Just as how the country has its constitution that governs, the laws of the land and all of that, the articles of incorporation is like a constitution for the company. It governs the run of the company. It sets out everything, just about everything that you need to know about the company. In terms of things like authorized share capital, we talk about authorized share capital. We're talking about how much shares are you authorized? What is the maximum amount of shares that you can issue at any given point? What is the maximum amount of shares you can have in issue at any given point? What is the maximum amount of shares shareholders can own at any given point in your company? You cannot go above that. And then the article may also set out ways in which you can amend it, of course, and how you can change the authorized share capital, etc. But also in the articles of incorporation for the company, we often have what we call a par value sometimes, what is the authorized amount, what is the recommended amount that the shares should be sold at. Commonly, as the book here says, it's commonly like, typically it is, in a lot of cases, it's very common for it to be $1 shares, yeah? But not because that is the recommended value to sell the shares at, means you have to. Sometimes shares are issued above par value or below par value, and it depends on lots of things. Right. So once you're a member of a company rather, you're a shareholder. And once you're a shareholder, you're an owner of that company. Yes? We have different types of shares, which we will delve into in a bit. Here are some key terms over here. So limited liability is the liability of any shareholder to the debt of the company, is limited to the amount of their fully paid up shares. So again, whatever you have invested in the company, that's what you're only liable to lose. The directors are the persons now who run the company. So even though we have many shareholders, because once you buy a share, you can buy as one share. You buy as little as one. Once you have a stake in the company, you're a shareholder. You're considered an owner of that company. However, all of those owners cannot run the company. You cannot just have everybody who's a shareholder running the company. No. So this is where we appoint certain officials to do this. We call them the board of directors. So a director is a person who is an official who is appointed by the shareholders to manage the company for them. So they do the running of the company. They can be, it says here, but doesn't have to be a shareholder. But in most cases, most instances, they are shareholders. Directors are usually shareholders. Sometimes there are some of the largest shareholders in the company, of course. No, people invest because they want to gain something on that investment. Nobody's getting up to investors because they want to give away money, unless we say they're what we call angel investors, meaning that they're investing to save a dying company and they take it and turn it around and make it profitable and all of that. But the aim of investing is generally to make returns on those investments. Therefore, you want to know that if you're going to invest your money in a company, you are getting something in return. Yes? So this is where what we call dividends come into play. Our dividends are whatever we earn on our investment in a company. So companies pay out dividends. And well, let me say they pay out dividends periodically because it doesn't have to be yearly. We'll get into that some more. We'll look at the types of shares and the type of dividends that goes with those shares. So your dividend, we have dividends, what we call interim dividends, which can be paid whatever time throughout the financial year. And then, of course, we have our annual dividends, the final dividends at the end of the financial year. But not every financial year dividend has to be paid out for. The company may not have money to pay dividends. But the idea is we like to think that it's an annual thing, but only if it is possible and only at the discretion of the directors. Because if they made a decision that, oh, this year we're not paying dividends because of XYZ, then you'll just not get any dividends. And of course, there are alternatives. So if they don't pay out dividends, they may give you bonus shares instead, give you more shares, so you have more ownership in the company. That way, they don't have to be giving out money, yes, to persons, but they still appease their shareholders, keep them interested in the company because they still get something in return. They get more shares, more ownership in the company now. Win-win, yeah. We talk about our par value, which is the same thing as our nominal value, which is the same thing as our face value, right? Which is the recommended value to sell the shares for. But again, as I said, you can issue shares above or below par value. Any amount in excess of par value that you issue the shares, difference between par value and what the shares was actually sold for goes to the share premium account. So where the shares are not issued at par value, the difference goes in your share premium account. Now we talk about share premium account is a type of capital account. Yes, that means it carries a credit balance because remember, accounting 101, capital is increased on the credit side. So we say it carries a credit balance. So let's get into the types of shares. Yes, been waiting to be here. We don't want them to get here. So the type of shares that we have, there are quite a few, but the two most common ones are ordinary shares and preference shares. So we look into both of them. Yes, ordinary shares. I like to do preference shares first, to be honest. Yeah. Preference shares. These persons, they say we have preferential rights to dividends over our ordinary shareholders. They're entitled to a fixed amount, a fixed rate of dividend. Yes, so every year they get the same amount. So if you have a 5% preference shares, if you have 5% preference shares selling, you know that you buy a couple amounts of it, you expect to get 5% in your return. So you already know before the year end comes, before the directors declare how much preference shares you're gonna get, you know, because it's fixed, it's a 5%. That's the rate for it, right? These persons are given preferential treatments in the fact that they are paid before ordinary shareholders. So your preference shareholders receive payments on their dividends. So we pay out preferred dividends before we pay out ordinary dividends. Yes? And the downside is that these persons don't usually have voting rights. So if you're a preference shareholder, typically you don't have voting rights in the company, as opposed to an ordinary shareholder who has a voting right, who have a say in the decision-making process, who can vote on matters. For the persons who don't like risk that much, we say they're risk averse, they don't like to take risk. Our preference, investing in preference shares is most recommended or most fitting for them because at least they'll know that it's a fixed amount that they're getting. Yes, every year they know that I'm getting this fixed amount here, and they'll get paid before the ordinary shareholders. But if you like to take the risk and you want, you know, go big or go home, and all in on it, then ordinary shares may be your thing. Ordinary shares, they're the most common types of shares, and companies will mostly issue ordinary shares. Ordinary shares, also called common shares. Yes, for obvious reasons, this is very common. If you see ordinary shares or if you see common shares, it is the same thing it's referring to. These persons, they receive dividend after the preference shareholders. So if no money is left, because dividends are paid out of profits, right? It is a profit after whatever is left for your profit. That's when you decide how much dividends you're going to pay. So based on the level of profits, if the directors pay out dividends to the preference shareholders and there's no money left for the ordinary shareholders, then you know who get knocked. ordinary shareholders cannot get anything because there's no money left for them to get. So that's why I said it's more risky. It's a more risky type of investment here in terms of the shares that you wish to invest in. However, the plus side is these persons get voting rights. They have a say. So at the annual general meeting, they can vote on matters. Their voices can be heard. Yes. Additionally, in the risk aspect of it is that the amount that you receive as an ordinary shareholder in the form of dividends may fluctuate year by year, right? So this year business was booming, profits were high and everything looks good. Ordinary shares get enough dividends, more than preference shares, preference shareholders, yeah? Next year comes, business going good again, but not as good as last year. They got less, but still good enough. Following year come, COVID hit, business decline, boom. No money. Ordinary shares get nothing. Nothing. Just like that. So it fluctuates. Their amount is not fixed. So the business is performing extremely well. They stand to benefit from that versus, preference shares. No matter how the business performs, it's a fixed amount they're still getting regardless. Now we talk about preference shares. I'm going back to preference shares now. I don't see it here, but we're talking about cumulative and non-cumulative preference shares. When we say cumulative, I need to write it on the screen if I don't see it, because I know lots of persons are visual learners like myself. Sometimes I don't hear if I can't see something. If I don't see something, I don't hear whatever you're saying. So I do acknowledge that. All right, this is talking about interim dividends. I don't see it here. I'm not sure if it's somewhere on this somewhere, but we're talking about preference shareholders. We say that we have cumulative and non-cumulative preference shareholders. Yes? What we mean by cumulative is the fact that, let's say this year, business fell, business made a loss. Remember, dividends are paid out of profits. Profit is the excess of your revenue over your expenditure, right? If the business made a loss, what are they going to pay the people if they don't have any money? Nothing. The company can't pay out profits from losses. No, can't pay out dividends rather from losses. You have to have a profit. So the business made a loss. There's no dividends to be paid out this year. If you're a cumulative preference shareholder, that would mean that next year come, they would still owe you for this year. So this year, 2019, they can't, well, 2020, COVID came and then, things mash up. In 2020, business made a loss, they can't pay us, they can't pay the shareholders their dividends. It carries over. If you're a cumulative preference shareholder, that means that when 2021 comes, you're supposed to get your dividend for 2020 plus 2021. If they still can't pay you in 2021, give you any dividends, when 2020 it rolls over again. So when 2022 comes now, they have to pay you, but they owe you from 2020, 2021 plus 2022. That's what cumulative means. It accumulates and it carries forward. Non-cumulative evidently is the opposite. If I don't get any money this year, it just don't get any money overall, and that's it. It doesn't roll over. That's it. You can't get any. Yeah. So your preference shares may be cumulative or non-cumulative preference shares. Ordinary shares, that's just automatically non-cumulative. If ordinary shareholders don't get anything this year, you're not getting that. It's gone. That's it. All right. Let's calculate dividends on preference shares briefly. Oh, here it was. I was talking about cumulative. Can be either cumulative or non-cumulative. Yeah. So here it is on the screen right there on this side. Basically what I just said. Now, in calculating dividends on preference shares, let's do an example here. A limited company has 200,000, 8% preference shares of $1 each. A dividend is declared. A shareholder with 1,000 shares would receive a dividend of, here's the calculation. It is 8% preference shares. That is a fixed rate on the preference shares. And it is 200,000 shares. Don't confuse the amount of shares with the monetary value of the shares. It's the same in this case because each share is $1. So you would take the 200,000 shares that you have, that's a quantity, that's the amount of shares, multiply it by $1, and we get the monetary value of the shares, which would be equal to $200,000. Yes. No, if this preference shares is carries a rate of 8%, dividends to be paid out would simply be 8% of the 200,000, which is, hold on, my bad. Shareholder, we're not doing the entire thing. For the entire company, dividends in total dividends that they would pay out under this. So let's do the company and look at the individual here. For the entire company, when they're paying out, they have 2,000 preference shares in issue, right? So when they are now coming to pay out all their preference shareholders for the year, the entire amount that they would pay out in dividends would be equal to 8% of the $200,000. Yes, 2/8 is what, 16. So I think this would give us, zero there, $16,000. That's what the company would pay out overall to all their preference shareholders in form of dividend for this year. However, let's say we have a specific shareholder who wants to know how much money he's going to get. So John comes to you, John says, you know, I own $1,000, sorry, I own 1,000 preference shares, and it's 8% preference shares. This is what John would get. He owns 1,000 shares. Remember, the shares have a value of $1 each. So the monetary value for one share, for John's shares would be 1,000 shares times $1 per share, which would mean that the monetary value for John would be $1,000. Yeah, that's the value of his share. And it is an 8% preference share, so it's going to be 8% of 1,000, which would equal to $80. So John will receive dividends of $80. That's just basic on calculating your dividends on your preference shares. Remember, you have a fixed rate. Yes? All right. Let's go back up now. Let's look at calculating dividends on our ordinary shares using a percentage. So a limited company has 100,000 ordinary shares of $1 each. A dividend is declared at 6%. Yeah? A shareholder with 1,000 off. So the directors come and they declare. That's what they usually do. So they come at one point and they will declare. Declare meaning that they announce that dividends will be paid on the shares in this amount. They can use a percentage method. They can say, all right, we'll be paying ordinary shareholders a percentage of 6% on their dividends, on their shares rather. We'll be paying ordinary shareholders a dividend of 6% on their shares. So every share, 6% per share. Yes? A shareholder that has 1,000 shares is going to get 6% of the 1,000, which would be $60 in terms of dividend. However, they may give you a rate where ordinary shares are concerned. So instead of saying we're going to pay ordinary shares at whatever percent, we're going to pay it at a certain rate. So for every ordinary share, we're paying 50 cents. Yes? Ordinary shares are going to be paid at 50 cents per share, for example. That's the rate method. So here, a limited company has, we're looking at illustration 2, a limited company has $100,000 ordinary shares at $1 each. A dividend is declared at 8 cents per share. So how do we calculate how much dividend this person with 1,000 shares would get? It is going to be 8 cents times 1,000. Because you have 1,000 shares. Yes. 8 cents times 1,000 shares that you have is equal to $8,000. Here, calculating dividends on ordinary shares with a nominal value less than 1. Remember, nominal value is the same thing as face value and par value. A limited company has raised $200,000 from issuing ordinary shares with a nominal value of 50 cents each. A dividend is declared at 2 cents per share. The number of shares issued, because they didn't give us the amount of shares. Yeah, they didn't give us the amount of shares. They gave us the dollar amount. To get the number of shares that were issued, it's going to be the dollar amount divided by how much you issued them for, which would have been 20 cents, 50 cents rather. So you get 4,000 shares being issued. and therefore the total dividend is 400,000. 400,000 shares being issued. So to get dividends, it would be 400,000 times 2 cents, because you are you're declaring that you'll be paying 2 cents per share. So we have 400,000 shares, and each share will get 2 cents on them as dividend. So overall, it's going to be $8,000 as dividends. All right. This is just a summary here of all the methods a while ago. All right, as I said, dividends can be paid interim or on a final basis. Okay, and continuing. These are just going through what would have taken place. All right, let's look at interim and final dividends. So preference shareholders receive a fixed rate of dividend, as we know, right? The total amount paid to preference shareholders cannot exceed that fixed rate. They can't get more than the fixed rate. So it does not matter to a preference shareholder if there's an interim dividend as well as a final dividend, because these two will be equal ultimately. So if they pay interim dividend, which amounts to half of what they should get at their fixed rate, when they pay the final dividends, the next half they're getting cannot exceed it. However, for an ordinary shareholder, they can receive two dividend payments that are totally independent of each other because there's no maximum. So they can benefit and it works out for them. So here's an example. A limited company has issued share capital consisting of 100,000 ordinary shares of $2 each and 50,000 6% preference shares of $1 each. During the financial year, an interim dividend of 5 cents per share is paid on the ordinary shares, as well as a final dividend of 10 cents per share. An interim dividend of $1,500 is paid to the preference shareholders, with the remainder paid as a final dividend at the end of the year. And here's how we're going to be calculating them. For preference shareholders, the interim dividend is 15. Here we go, $1,500. Final dividend is 15. How did we get that? 6% preference shares. There are 5,000 preference shares, and it's 6,000. So it's going to be 50,000. There are 50,000 preference shares at $1 each. The total dividend for preference shares is going to be the 50,000 times the 6%, which is going to be 3,000. They cannot get more than 3,000 for their dividend for the year. Right? So they cannot get more than 3,000. And in that case, the interim dividend that they got was 1,500. That means the final dividend that they have to get is the difference between the total dividend that they should get, 3,000, and the interim that was already paid, which is 1,500. So they'll get 1,500 as the final. When it adds up, it cannot exceed total dividend. For ordinary shares, however, you realize here that they got, so we have 100,000 ordinary shares of $2 each. Yes? And we're saying, all right, we'll be paying ordinary shares an interim of 5 cents per share for ordinary shareholders. So the interim dividend is 5 cents per share. We have 100,000 shares, so it's 5 cents times 100,000, which is 5,000 for interim dividend. The final dividend now, final dividend of 10 cents per share for our ordinary shareholders. We still have 100,000 shares, right? Multiply that by 10 cents, because for every share, for one share, it's 10 cents, yeah? So for 100,000 shares, it is 100,000 times 10 cents, which gives you $10,000. So you realize the total dividends paid out to ordinary shareholders would have been the 5,000 plus the 10,000, which gives us $15,000. Please note over here, the maximum amount of dividend that the preference shareholders can receive in this example is 3,000. Yes, the directors have decided to divide the total payment into two payments of equal amounts. Ordinary shareholders have no maximum or minimum amount of dividend, as their dividend depends on the level of profitability, as we said. You may pause the video here and capture these practice questions and work them out. Here's a tip of where you can find the solutions online. So you can just take a screenshot. All right, so in the next video, I'll explain the issue of shares. I'm going to talk about authorized share capital some more, which we really would have talked about earlier, and we'll delve further into the topic. So I'll just put that in the next video so we don't have to sit through too many long videos. Hope you learned something. We're just getting started. The fun part is yet to come.